Buy the dip, the saying goes, but when is the right time to buy the dip? We've had a look at some research to help us think about when is the right time to buy as the market falls.
Yeah, this is a question that we get all the time. Buy the dip, which is great.
All the time, particularly at a time
like this. Buy the dip. But is now the dip? When's the dip? Should I buy now?
So before we get to the timing, let's just, for people who are newer to the narrative around buying the dip, just some data to just explain why we say buy the dip, why it's such a common phrase. So this is research from Ritholtz Wealth Management, and it looks at the S&P 500, so the American index, returns after a 15% drawdown. So after the market has fallen 15%, how does it look on average 1 year later? On average, it's up 15%, and 83% of the time it's up. 3 years later, after a 15% drawdown, on average, it's up 41%, and it's up 96% of the time. After 5 years, on average, it's up 66%, and then it's on average up 92% of the time. 92 in total, 92% of the time it's up. But this is where the data gets really exciting. This is why we love long-term investing, because after 10 years, on average, the market is up 186%. So you've almost tripled your money, and it's up 100% of the time.
No brainer.
You can't
You
find
can't. You can't lose.
You can't find a 15% fall in the S&P 500's history where you go forward 10 years and you're still down.
Love that. I mean, the stat
and
we
you're
always
down,
say is
yeah.
20 years, but we need to be dragging that in because that's what you need to be showing your friends every time that there's a market dip and people are telling you you're crazy for putting money in.
Yeah. So the question then becomes, when's the right time to buy the dip?
Now.
And that is really that's the message we want to get across. The market, the name of this segment is The Market Doesn't Wait.
It doesn't. And what we're like, so I guess to just unpack that, a lot of people are thinking at the moment, well, you know, how can we be at the bottom of the market when the tariffs haven't even kicked in at the moment? This seems wild. We've had this drop. Trump's done all this crazy stuff, but we're really not actually seeing anything implemented at the moment. Surely there's more to come.
Yeah, surely company profits are going to fall. Surely the economic, the overall economic activity will slow down. Surely there's more to come.
Yeah, and they're right. They are right. Yeah, I mean, there could be more to come. But the thing is, the share market is all about looking forward.
Yes.
It's about looking not just tomorrow, but like what is. Look, it's a forward looking. It's trying to pick. It's telling us about the future.
Yes. So data from 2020 to illustrate that point that the market is forward looking. So the S&P 500 bottomed in March 2020. GDP in America bottomed 3 months later. And then earnings per share, so companies' profitability, actually bottomed 13 months later from the S&P 500 bottom. That is the market being forward looking. It's not trying to pick where marry up to where like companies' profits will fall. If it sees that profits will fall, but then they'll rise after that, it's looking out. It's looking in those out years and beyond that. And so that's why the market doesn't wait. That's why the market moves first before the economy and before companies. And so if you'd waited until companies' earnings had bottomed out, you would have missed the rebound. The S&P was up more than 60% 13 months later. It was up more than 25% from where it was before it crashed.
Yeah, I mean, this is why trying to time these things is near impossible.
And you might argue that, well, 2020 was an outlier. Like it was so different. There was so much different stuff going on. That's not indicative of how the market always works. Well, let me take you to every bear market since 1957. Every time the market has fallen 20% or more in the last 70 years, on average, earnings bottom 9 months after the market bottoms.
Yeah.
So this is why the market doesn't wait. And this is why as investors, you can never pick the perfect time. But this is why so many investors miss the bottom, because they try and wait until the company news has turned.
Yeah, when the news hits rock bottom, it's too late.
Yeah.
Yeah, it's like, and look, things are definitely going to continue to play out in markets at the moment. Who knows what Trump's going to come out with? He could come out with news that is worse than what people are now expecting, and we could continue to see markets fall. But yeah, our message here is don't wait, just dollar cost average.
Yeah.
Take those opportunities.
Yeah. So look, putting that all together, returns after a 15% drawdown historically over the long term,
Love that.
that has been a good time to buy, and we're more than 15% down at the moment. Over a 10-year period, the amount of times that you're up is 100%. And in terms of when the right time to buy is in the market dip, you never know when the right time is, but the market turns before the news turns, before the economy turns, before companies' fortunes turn. And so you're never going to be able to nail the right time because the market turns first. And so because it doesn't wait, we are saying that you shouldn't either.
I would be writing that stat down in your phone, tattooing it on your arm, wherever you need to write it down, so that when a moment like this happens again and there is an emotional drop of 15%, you remind yourself that there has never been an instance where after 10 years you would have lost your money.
Yeah. Now,
that is wild.
We've been trying to explain some charts here. So what we'll do is we'll include these charts in an Instagram post the day this episode goes out. So you can have a look at them. But I think that's a reminder of the power of long-term investing, the power of staying invested, and the power of doubling down in these buying opportunities.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.